Hi and welcome to this video. Through this video, I'm going to attempt to simplify the concept of currency swaps. We're going to do this with the help of an example to facilitate a better understanding of this topic. So let us begin. Let us begin understanding with the help of a scenario. We have two companies in front of us, Company A and Company B. Company A is a company which is based in the UK with its local currency being pounds, while Company B is a company which is based in the US with its local currency being US dollars. Now Company A wishes to expand its operations in US, for which it is going to have a requirement of say $25 million for a duration of 1 year. On the other hand, Company B wishes to expand its operations in the UK, for which it is going to need an amount of £40 million for a duration of 1 year. We have the borrowing interest rates for each company in both the currencies, in GBP as well as dollars. So if Company A borrows money in GBP, which is its local currency, it would be paying 7% per annum, while if it borrows in US dollars, it would be paying 5.60% per annum. On the other hand, if Company B borrows the required currency in GBP, it would be paying an interest rate of 7.20% per annum, while if it borrows in the US dollars, it will be paying 5.50% per annum. So the bottom line here is that borrowing locally in the local currency is cheaper than borrowing in a foreign currency for each of these companies. So how can the two companies take advantage of this situation and fulfill their goal of attaining the necessary foreign amounts? This can very well be done through an arrangement of currency swap. What is a currency swap and what is the purpose of a currency swap, and how can these two companies use this arrangement? A currency swap is a method used to hedge against a foreign exchange risk exposure. As you can see, both these companies wish to borrow a foreign currency, and hence of course they are exposed to foreign exchange risk. So through currency swap they can actually hedge their foreign exchange risk. There are just two, to simply put it, there are two basic purposes to a currency swap. One is of course to hedge against the foreign exchange exposure risk, and the second one is to minimize or to reduce the cost of its borrowing of foreign currency. Alright, now what happens in a swap is two counterparties, here Company A and Company B, they come together and they agree to borrow on behalf of each other, and then they swap these principals and interest rate commitments, and that's how they fulfill their purpose. I've broken down this whole process into two simple steps for an easier understanding, and so let us dive into the step one. Step one, at the inception, that is at the beginning of the period. What happens is the principal amounts are borrowed in local currencies by each of these companies on behalf of the other. As you can see in the scenario, Company A has a requirement of US dollars while Company B has a requirement of pounds. So what happens is now Company A borrows pounds on behalf of Company B, and Company B borrows dollars on behalf of Company A. Okay? And what would be the applicable interest rate of borrowing? The applicable interest rate of borrowing for Company A, since it is borrowing in GBP, would be 7% per annum. While for Company B, since it is borrowing in US dollars, which is its local currency, its applicable interest rate will be 5.50% per annum. Fair enough. So this is what happens at the inception. The principal amounts are borrowed in local currencies by each of these companies on behalf of the other. Next, what happens is once this borrowing is done from the bank or any financial institution, now the companies interchange the principals. So what happens is Company A transfers the borrowing to Company B and Company B transfers this borrowing to Company A. So to simply put it, company A receives $25 million while company B receives 40 million pounds. Now this exchange of principals is done at the prevailing spot rate. Whatever is the prevailing exchange rate at the time of transfer is used. Step 2. So at inception the principal amount is borrowed, and then there is this exchange of principal that takes place at the spot rate. What happens next? At the end of the period, what happens is, say the purpose is served because both companies had a requirement of the capital for a duration of 1 year. Now at the end of this period, what happens? At the end of this period, of course, there will be, since it is 1 year, there will be an interest payment, there will be an interest obligation. So each of these companies would pay their respective interest payments to their banks. Company A would pay interest on 40 million pounds, while company B would pay on 25 million pounds. So if we calculate the interest payable by both these companies, company A would be paying an interest of 40 million GBP multiplied by 7%, while company B would pay an interest on $25 million at 5.50%. Here we arrive at GBP 2.8 million, and here we arrive at $1.375 million. So these are the interest payments made. You think these companies will bear the interest by themselves? No. Again, the burden of the interest is also transferred to the respective company. So again, there is an interchange of this interest rate commitment. What happens is, company A is reimbursed by company B for the 2.8 million pound interest expense that it incurs. On the other hand, company B is reimbursed for the expense of $1.375 million that it incurs on behalf of company A. So again, there is an interchange, there is a swap of interest rate commitments. At what exchange rate does this take place? The exchange rate of interest payments may be done at the prevailing spot rate at the time of exchange. Finally, what happens is, the transaction is complete and we've reached at the end of the period. So what happens is, now the purpose is served, you need to pay back the banks. So this interest amount is again re-swapped. This interest amount is swapped back. The principal amount is re-swapped. The principal amount is swapped back by the companies. So company A again receives 40 million pounds from company B, which it will repay the bank, and company B receives $25 million from company A, which it will repay its own bank from where it's borrowed. Again, at what rate will this transfer take place? This transfer will take place at the original exchange rate, at the original spot rate at the time of your first or your original swap. So in effect, if you see the net result, hadn't these two companies gone for a swap arrangement, for a currency swap arrangement, what would be the interest cost expense that they would incur? The interest cost expense that they would incur as a result would be, company A would incur an interest cost expense of $25 million into 5.60%, which is 1.40 million, while company B would incur an interest cost expense of 40 million pounds multiplied by 7.20%. And with the swaps, as we saw, this is interest expense. So there's a saving if you see, with and without. The interest cost is definitely lower in case of the swap arrangement. Hence you can clearly see that the currency swap is definitely a more beneficial arrangement for the two companies involved in here. So this is what a fixed currency swap looks like. Let us summarize all the points that we discussed in this video. First, what is the purpose of a currency swap? There are two basic purposes. One is to hedge the exposure to exchange rate risk, and the second is to reduce the cost of borrowing foreign currency. Second, we discussed this scenario, and with respect to this scenario, we actually put down a solution in two simple steps. One was at the inception and second was at the end of the period. At the inception, what happens is each of these companies, okay, they borrow the principal amount in local currencies on behalf of the other. And then next what they do is they exchange these principals. The principal is exchanged at the prevailing spot rate. In step 2, which is at the end of the period, the interest rate obligations are paid to the bank, to the respective banks, to the respective lenders, and then these commitments are again exchanged. And finally, the principal, the original principal amount is re-swapped. We then arrive at the net result in order to ascertain the gain or the loss on the swap arrangement. With this, we conclude our discussion on fixed for fixed currency swap. Thank you for watching.